When businesses look for ways to raise capital, they generally have two primary options: equity financing and debt financing. Each method has its own advantages and disadvantages, and understanding the key differences between them is essential for business owners, investors, and financial professionals. Equity financing involves raising capital by selling shares in the company, while debt financing involves borrowing funds that must be repaid with interest. In this video, we'll explore the top 10 differences between equity financing and debt financing to help clarify which might be better suited for your financial goals. 1. Ownership and control. The fundamental difference between equity and debt financing lies in ownership and control of the business. Equity financing involves selling a stake in your company, which means investors become part owners. They may have a say in company decisions, especially if they hold a significant amount of shares. In contrast, debt financing does not affect ownership. You borrow money, and the lender has no claim to your company's equity or decision-making. You remain the sole owner, with no dilution of control. 2. Repayment obligations. A key distinction between these two financing methods is the repayment obligation. Debt financing requires the business to repay the borrowed amount along with interest, according to an agreed-upon schedule. Failure to meet repayment terms could result in penalties or legal consequences. On the other hand, equity financing does not require repayment. Investors make a return on their investment through dividends or the potential for capital appreciation, but they do not expect regular repayments or principal repayment at a fixed time. 3. Risk to the business. In terms of business risk, equity financing generally presents less financial risk because there are no fixed repayment obligations. However, you may lose control over business decisions if investors acquire substantial ownership. In contrast, debt financing introduces higher risk, particularly if the business faces a downturn and cannot generate sufficient revenue to meet debt obligations. Not being able to repay the debt can lead to bankruptcy or forced liquidation of assets. 4. Cost of capital. The cost of capital is another important consideration. Debt financing is often less expensive in terms of interest rates, especially when interest rates are low. However, the cost is still significant because you must repay both the principal and interest. Equity financing, while it doesn't require repayments, often comes with a higher cost because investors expect a return on their investment in the form of dividends and capital gains. The cost is not fixed and is tied to the company's growth and profitability. 5. Impact on financial statements. Debt financing impacts a company's balance sheet directly. It increases liabilities, which can affect financial ratios and leverage. Interest payments are considered expenses, which reduce taxable income. On the other hand, equity financing affects the equity portion of the balance sheet. Since no interest is paid to investors, equity financing does not affect income statements in the same way as debt does, but it dilutes ownership and can lower earnings per share. 6. Tax implications. One advantage of debt financing is that interest payments on debt are tax deductible in many jurisdictions. This provides a tax shield for the company, potentially lowering its overall tax burden. Equity financing, however, does not provide such tax benefits. Investors typically expect returns in the form of dividends, which may not be deductible for the business and can be subject to double taxation, once at the corporate level and again when investors receive dividends. 7. Flexibility in use of funds. Equity financing offers more flexibility because there are no restrictions on how the funds can be used. Once the capital is raised, the company has the freedom to invest in any aspect of the business, whether it's expansion, hiring, marketing, or research and development. In comparison, debt financing often comes with specific conditions or covenants that limit how the borrowed money can be spent. Lenders may impose restrictions to ensure that the funds are used for specific purposes that support the company's ability to repay the loan. 8. Investor expectations. Equity financing comes with investor expectations for growth and returns. Investors will expect a return on their investment through dividends or capital appreciation, which can create pressure for the company to grow rapidly and increase shareholder value. In contrast, debt financing involves lenders who are primarily concerned with receiving timely interest payments and repayment of the principal. Their expectations are typically more focused on the company's ability to meet the terms of the loan rather than rapid growth. 9. Effect on creditworthiness. For businesses seeking additional financing in the future, debt financing can affect creditworthiness. Taking on debt increases a company's liabilities and affects its debt-to-equity ratio, which can impact its ability to borrow more money in the future. Too much debt may signal financial instability to future lenders. On the other hand, equity financing does not affect creditworthiness directly because it does not introduce liabilities to the balance sheet. However, it could influence future funding strategies if the company's ownership structure changes significantly. 10. Long-term impact on ownership. Equity financing results in a permanent change to the ownership structure of the company. Once shares are sold, those investors have ownership stakes that are unlikely to be reversed unless the company buys them back or they sell their shares to others. This means that if you choose equity financing, your ownership and control of the business may be diluted over time. Debt financing, however, does not change ownership, and once the loan is repaid, the relationship between the lender and the company ends, allowing the business to retain its original ownership structure. In summary, both equity financing and debt financing offer distinct advantages and challenges. Equity financing provides flexibility, reduces financial risk, and eliminates the need for fixed repayments, but it results in ownership dilution and can be more expensive in terms of investor expectations. Debt financing, on the other hand, is typically less costly, offers tax advantages, and allows the business to retain full ownership, but it introduces repayment obligations and financial risk. The choice between equity and debt financing depends largely on the company's financial goals, risk tolerance, and stage of development. New and high-growth companies may opt for equity financing to avoid the pressure of debt repayment, while more established companies with stable cash flow may lean toward debt financing to maintain control and minimize dilution. Ultimately, a well-balanced approach that considers both equity and debt may be the best solution for many businesses.